Welcome to this monthly outlook on debt markets from Canara Robeco. Last month has been all about the tariff negotiations the US has been having with its partners. Finally, in last 2 days, the Trump administration has given out tariffs for various countries. Earlier, they agreed to tariffs with UK at 10%, with the European Union recently concluded at about 15%. Rest of the countries, the tariff ranges from 10 to 40%. India, unfortunately, had been handed out a tariff of 25% plus an unspecified penalty for trading with Russia for oil and energy and for weapons. India had been in talks with the US counterparts for last 3 months. Unfortunately, they could not come to any conclusion. India will continue to talk to US administration for the trade agreement in the coming months. But obviously, the tariff imposed unilaterally by President Trump setbacks the negotiation process a bit. In terms of markets, the US FOMC has been able to ignore the pressure from US administration, keeping the rates constant and not delivering a rate cut as was expected or as has been expected by the US administration. The FOMC chair, Jerome Powell, has been pointing out to inflation pressure from the tariffs which have been imposed by the US on other countries. Since this process was delayed by 3 months till August, the inflation pressure may start creeping in the coming months as the tariffs are now fully imposed on various trading partners. In terms of market reaction, it was not very volatile. Markets have been trading in a broad range of, if you look at US 10-year as a benchmark, a broad range of 420 to 440. It seems markets have got some sort of relief because in the reciprocal tariffs announced by President Trump on April 2nd were pretty high. Now the tariffs announced are less than half, so markets have been given some relief, and with even the 10% baseline tariff which has been there in the US imports, the inflation has not reacted too much, though there is some inflation seen in the primary articles in US. But overall, it seems that companies are absorbing the extra cost and not passing it on to the consumers. To that extent, the inflation has not spilled over to the consumer prices. Overall, the situation remains volatile, but yes, we have reached some sort of conclusion to the tariff rates. Obviously, going forward, the rates may go up and down depending on further negotiations. These rates have been very broadly agreed upon, and the overall framework is still uncertain with various countries. So, coming months will also disclose what is the exact fine print in the trade agreements. There may be rate changes also depending on how countries continue to negotiate with the US administration. Coming to India, the 25% tariff from the US has been a bit of shock and disappointment for the Indian government because they had been negotiating in good faith and trying to agree to certain trade agreements where they would agree for lower tariffs on US imports in India. However, there was a lot of disagreements, it looks like, and US could not reach an understanding with the Indian counterparts. Overall, Indian macroeconomic indicators remain very good. If you look at inflation, inflation was 2.3% in the latest reading, and the lowest in almost 4-5 years. Overall inflation trajectory may remain low, below 4% target of RBI. However, RBI surprised the market in June when they cut rates by 50 basis points, but shifted stance to neutral, pointing out that they are front-loading rates and they see inflation at over 4% in FY 26-27. So, from a forward-looking perspective, they would like to move to a neutral position on the stance. However, the Governor Malhotra pointed out that the neutral stance means they can move in either direction, and depending on incoming data, they will be taking a decision in the Monetary Policy Committee. Overall, markets in India have been range-bound with a little bit of upward bias on yields. Overall, the 10-year yield has moved between 630 to 640 in the near term, and we expect that markets may move sideways to the policy. The very low inflation which we have seen in the first quarter of FY26 may give some food for thought for the Monetary Policy Committee members, because the expectation was 2.9% for the first quarter of FY26, while the actual reading has been about 2.7%. So the undershooting of inflation has been there. If the undershoot of inflation continues for next 1 or 2 quarters, there is expectation that RBI may deliver one more 25 basis rate cut by December. That is the market. Some of the participants are market are speculating that it could happen. However, because of change of stance, the market sentiment has got hit, and obviously, as now the rate cycle seems to be in a long pause, market direction will be driven by global cues like oil prices, US rates, geopolitics, and also obviously the Indian macro situation, especially related to inflation and growth. The US tariff of 25% could slow down exports to a certain extent, which may impact growth, and RBI may take steps to ensure that local demand remains robust. To that extent, there could be possibility of one more rate cut. On the liquidity side, RBI in the initial part of calendar 2025 have been injecting liquidity via open market operations of purchase of government securities. However, in last 1.5 to 2 months, they have taken reverse steps where they have been withdrawing short-term liquidity through variable reverse rate repo auctions and bringing the surplus down in the system. That also seems to have hit the sentiment a bit. In the coming policy, we will get to know more about what liquidity stance RBI is taking, and markets will further move from there depending on the RBI's thought process. Indian 10-year will likely move between 630 to 645 range in the near term. We do not anticipate any big sell-offs in the market because demand supply remains in good balance and there are good demand for government securities by investors. For the investors, now that RBI is in a neutral stance, the duration play will not deliver as much return as it has delivered in the last 8 to 12 months. For the investors, the duration play may not give benefit in a situation where market is moving sideways, and it could be better for investors to look at short to medium term funds like corporate bond funds, short duration funds, and banking PSU debt funds. As usual, investors should look at their risk and investment horizon while investing in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.